The Federal Reserve Bank just raised interest rates for the 10th consecutive time. Today, Jerome Powell announced that the Federal Reserve Bank will raise interest rates by another 0.25%, bringing interest rates up to 5 to 5.25%. This is the highest interest rates that we have seen in America since September of 2007. And the last time we saw interest rates higher than this was the year 2000, right before the dot-com bubble bursting. Interest rates stopped at 5 to 5.25% back in September of 2007, and then the economy crashed during the 2008 crash, and that was when the Fed started their cutting cycle. So we haven't seen interest rates this high since the 2008 crash cycle, and that was the peak of interest rates back then. But what's even more interesting, besides the fact that now we have interest rates a little bit higher, is that interest rates could potentially go even higher in the future, because one of the biggest questions that Jerome Powell, who is the chairman of the Federal Reserve Bank, kept getting is, will the Federal Reserve Bank be pausing or cutting interest rates anytime soon? And let me just read you directly what Jerome Powell said regarding pausing interest rate hikes. What he said is, quote, "A decision on a interest rate pause was not made today." He said that there's a sense that we're close, much closer to the end of this than the beginning, meaning, according to him, we're closer to stopping the interest rate hikes than we are to when we first started. But when are we going to pause? No clear answer. Now, of course, we've been talking about the impacts of higher interest rates for a while. One of the impacts of higher interest rates is that borrowing money becomes more expensive, and also it impacts the valuations of certain investments like bonds. That affects banks, because banks own certain investments like loans, aka bonds, and as interest rates go up, the valuation of these bonds go down, and so you see a lot of banks holding on to underwater assets, which is a big reason why we've seen banks like First Republic Bank collapse, why Silicon Valley Bank collapsed, and why Signature Bank collapsed. And so naturally, Jerome Powell commented on the banking sector about what's going on, about how high interest rates will continue to affect banks. What he said is that conditions in the banking sector have broadly improved since early March. That was back when Silicon Valley Bank happened, and the US banking system is sound and resilient. Now, you might be wondering, how can the banking system be sound and resilient, and how could it have improved since the Silicon Valley Bank collapse happened if people have been pulling their money out of regional banks? Another bank just collapsed. First Republic Bank was the largest of the three banks that collapsed this year. First Republic Bank was actually the largest bank to collapse since the 2008 crash. So how can the banking conditions have improved? Well, let me just explain that with two parts. The banking system depends on you investing, meaning saving your money at the bank. And what has been happening is people have been pulling their money out of regional banks, especially because they want to keep their money in a safer, larger bank. And that has hurt the ability of regional banks to be able to lend money, because if they don't have deposits, they can't go out and lend money, they can't make money. But after the Silicon Valley Bank failure, the Federal Reserve Bank created a lending program which allows some banks, particularly regional banks that are struggling, to borrow billions of dollars easily. That way they can continue staying operational. So my assumption is, when you say that the banking condition has improved since March, even though we've seen a lot of people pull their money out of these regional banks, has to do with the fact that banks have been able to borrow billions and billions of dollars from the Federal Reserve Bank. That way they can continue operating. However, there were some other economists that talked about the same topic before, which is we're going to see the profitability of many of these banks get hurt, because in order for them to continue operating and making loans, they have to borrow more money, meaning the operating costs have gone up. So interesting to hear that about the banking sector. But of course, the Fed wants to make sure that people feel safe keeping their money in the bank, saving their money in the bank. So you have to keep telling people that the banking system is safe, which, like Warren Buffett said, it's not likely that people are going to lose money by saving their money in the banking system, especially because the government and the Treasury Department and the FDIC have essentially guaranteed all deposits until who knows when, but up until now, they've essentially guaranteed all deposits. So an interesting comment about the banking sector. But then Jerome Powell did go on to talk about interest rate cuts in the future. Now, we did a whole deep dive of this in Market Briefs. my free financial newsletter, which is why if you have not joined Market Briefs, I highly recommend you do so. It's a free way and an easy way for you to stay up to date on what Jerome Powell and the Fed is doing. It's an easy way for you to keep up to date on what's happening in the economy, the housing market, the stock market, the crypto market, and the global economy. It's a fun, witty, and easy to read email, and you can read it in less than 5 minutes every morning, and it's free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. But when it came to interest rate cuts, because Jerome Powell kept being asked, is the Fed going to start cutting interest rates soon to help boost and stimulate the economy? What he said is, quote, inflation is going to come down not so quickly. It will take some time. And in that world, if the forecast is correct, it would not be appropriate to cut rates. Essentially what that means is that if the Fed were to start cutting rates, that would cause inflation to go higher. And right now, inflation is not coming down fast enough. And so it doesn't make sense for the Fed to start cutting rates. That's what he's saying today, and he's been saying that for a while. But the big question mark, concern, and worry people have is what happens if we see a bigger economic slowdown? If we see our economy take a nosedive, because things can flip very quickly. If you remember just about a month and a half ago, when Silicon Valley Bank crashed, that flipped sentiments about the economy like overnight. And so we could see a flip in the economy very quickly, which could force the Fed to take drastic action. And there are consequences to that, because you might be wondering, why doesn't the Fed do something now to stimulate the economy? Well, it goes back to inflation. Inflation is a big problem. Not only is inflation not under control, if the Fed started to cut interest rates, inflation would become even more out of control. And unfortunately, the reality that many people don't want to accept is that controlling inflation is more important than controlling a recession, because we can get out of a recession. We have done that many times. Getting out of an inflation crisis is significantly more difficult and significantly more painful, because an inflation crisis can induce a currency crisis. And a currency crisis can destroy our economy as we know it. And this is where getting inflation under control is very important. And the Federal Reserve Bank will have to do things that unfortunately cause pain to the economy. And the reason why the Federal Reserve Bank has to do it is because we got ourselves into this mess of overstimulating, overprinting, and overspending, not just over the last few years, but over the last number of years. And so in order to remedy these issues, in order to remedy the inflation, we have to prick the bubble that we created, which means we have to get some of the money out, cool down the inflation, and a byproduct of that is, unfortunately, economic pain and job losses. This is something that we're starting to see happen. But on the topic of job losses, we got an interesting report today from private payrolls. And what private payrolls are, it's companies that are private who go out and hire people. And the estimate today was that in April, that we would see about 142,000 jobs added in the private sector. Well, according to the data, 296,000 private payrolls were added, which means a lot more jobs were added than expected. Now, on one hand, there's good news. More people are getting hired than expected. The job market is stronger than expected. But then on the inflationary side, what the Federal Reserve Bank is looking at, that's not good news, because the Federal Reserve Bank wants to cool down demand. They want people to stop spending so much money. And if people are earning money, they're going to continue spending. And so for the Federal Reserve Bank, in order to cool down inflation, meaning they want the prices of things to not rise so much, they need less demand out there. Think about like buying a home. If there's a home that's available for $500,000 and 80 people are bidding on that home, what's going to happen to the price of the home? It's going to sell for way more than $500,000. But if there's only 2 people bidding for that home, it might not sell for even over asking. It might sell for under asking. And this is where the Federal Reserve Bank wants to reduce demand. How do you reduce the demand, or how can the Federal Reserve Bank reduce demand? Well, they can make things less affordable. That's what the Federal Reserve Bank has the power to do. And the way they do that is by making borrowing money more expensive. How? By raising interest rates. And so when people are getting jobs, they have an income, they have the ability to spend, and they have the ability to continue stimulating and buying things, which increases demand. And that's why what the Federal Reserve Bank keeps saying is a loosening job market, a loosening labor market is a necessary byproduct to bring in inflation down. Because if people are not getting jobs, if people are losing jobs, what does that mean? People have less ability to spend. If people have less ability to spend, that cools down demand, which can help cool down inflation. And so this is where now, between now and the next Fed meeting, what Jerome Powell said is that they're going to look very heavily at the data. It's going to be a data-driven decision as to what they do with interest rates, whether they pause interest rates or raise interest rates again. And one of that data that they're going to be looking at is jobs. Because if the job market stays strong, that's an indication that inflation will continue to stay strong. If the job market starts to weaken, that's an indication that inflation can also start to weaken. But in addition to that, they're also going to be looking at things like the CPI numbers, the inflation numbers. They're also going to be looking at things like the economic growth. Now, we are seeing the economy slow down a little bit, but this is where the Federal Reserve Bank's decisions are going to become more and more crucial, because every time they raise interest rates to cool down inflation, it has consequences. And the consequence is going to show up in the economic side, in addition to the inflationary side. But most people don't really feel the effect when inflation falls a little bit, but they definitely feel the effect when you see more layoffs and you see more job losses and you see more bankruptcies. So you definitely want to keep up to date with what's going on with the Fed, the economy, and interest rates, and we'll be helping you do that with market briefs, which is why if you haven't subscribed yet, make sure you do so. But this is where you also want to make sure you're protecting yourself and your family financially, because, well, this inflation problem and economic slowdown doesn't look like it's going away anytime soon.